Meta is exploring a potential $10 billion bond deal, which is very interesting because the company doesn't have any debt on its balance sheet and has a lot of excess cash. So the question is, why are they doing this? Well, that's what I'm going to cover in this video. So guys, smash that like button, subscribe if you're new, and of course, drop a meow in that chat. You're watching More Money. Let's get it. What's up, guys, and let's get right into this one. You can see here that it was reported recently that Meta is exploring a potential bond sale, which will be its first ever. And diving deeper into this article that was reported by Bloomberg, you can see that Meta has asked banks to hold investor meetings for a potential bond sale. Now, up until now, Meta has largely sat out of the bond market, and it's one of just 18 companies in the S&P without outstanding short or long-term debt, of course, excluding those lease liabilities. And so the question is, what is the purpose of raising debt right now? Well, Bloomberg intelligence analyst Robert Schiffman says that it could be focused on increased capital spending focused on the metaverse, along with rising share buybacks. But I just don't think that those are the main reasons. Now, that's not saying that those aren't part of the reason, but I think that there might be something else going on here. Now, notice that Meta had roughly $40.5 billion of cash and cash equivalents on hand as of their Q2 reporting. And if you watch their balance sheet, notice that they've always had a ton of excess capital on the balance sheet. And so this bond sale is not due to a lack of liquidity. In fact, the company has quite a bit of liquidity. And you guys are already aware, Facebook is a free cash flow per share or free cash flow generating juggernaut. They don't need to raise debt in this environment. At least I don't think that they do. So the question is, why are they raising this debt or potentially raising this debt? Well, here's where we can speculate a little bit. And I have a lot of fun speculating. Look, I might be wrong. You guys tell me in the comments why you think that they're looking to raise the debt. But this does remind me of a company maybe 10 or 12 years ago by the name of Goldman Sachs. You guys might remember the property crisis that happened in the US around 2008 or 2009. Well, Goldman Sachs wasn't going under, but they still managed to raise debt in that environment because they just wanted to show that they were very strongly capitalized. And the reason why they did that wasn't because they needed the funds. The reason why they did it is because they believed that things could get worse. And so right now, you guys have heard that Meta's CEO, Mark Zuckerberg, is saying that we are on the cusp of one of the worst recessions that we've seen ever. And so they're really hunkering down and they're looking to even reduce staff in this environment just to sort of become more nimble. And they're the ones who are sort of the strongest on their sort of wording with respect to that, at least in the tech space. And so it's very believable that they would want to shore up their balance sheet even more by having access to additional amount of capital. Now let's go back into that Goldman Sachs example. Well, you can see here that the Meta bond deal, in my opinion, is more likely being done to ensure that the business is well capitalized and has sufficient liquidity in an environment where share prices collapse. And so this capital could also be used for key acquisitions. And so remember that in 2008's global financial crisis, Wall Street firms ensured that they had access to adequate capital. And so that's where Goldman Sachs actually borrowed $5 billion of capital from Warren Buffett's Berkshire Hathaway. And as you can tell, they didn't really need it because just a few weeks later on October 27, the firm or Goldman Sachs received an injection of $10 billion under the Capital Purchase Program funded by the US TARP program. And what ended up happening is Goldman Sachs actually ended up paying back that $10 billion of TARP investment just 8 months later. And on March 2011, Goldman Sachs actually announced that it exercised its options to buy back Berkshire Hathaway's shares 2 years early. So effectively what they did is they got access to that capital, and then as soon as they determined that they didn't need access to it anymore, they paid it back. And the reason why they didn't need access to it is because the market just did not decline at the rate that they thought that it could have the potential to go down at. And so they didn't need that cash anymore. And I do believe that that's exactly what Facebook is doing right now. And they might even raise more than the 10 billion. They might do 20 billion. Hey, look, it's good to have cash on hand when the window dries up. And that could provide really good opportunities for them to snap up competitors that complement their business, like Snapchat. Now, guys, before I go into my valuation, just a reminder that 80% of the watch time on this channel is from people who aren't subscribed. So if you have a chance, please consider hitting that subscribe button. Now let's go into our valuation for Meta. You can see here that although issuing debt to buy back shares can be a good strategy to give values to shareholders. It's not as great of a strategy because the valuation may not necessarily move considerably, because increases in EPS will be offset with reductions of the excess capital line. And so if they do raise that debt and then they buy back shares with it, yes, you're going to get a higher EPS, but then you're just going to have more debt on the balance sheet. So that excess capital per share will decline, causing the valuation to effectively go back to where it is. But notice that I'm valuing the company at approximately $225, $250 per share. My valuation multiple is low. This company might require a 20 times multiple, but I'm just giving it a 17.5 times multiple because I feel more comfortable with that. So the share price as a percentage of its intrinsic value at the current moment is around 75%, which is not a bad price for Meta. And so buying this company at under $200 per share is not a bad place to be. Now, another company that I typically cover, which is levered to ad spending like Facebook is Alphabet. And I actually talk about that company and if there's an opportunity to purchase those securities in this video right here.